Good morning, everyone. Thanks again for joining. My name is Frank Milone. I'm one of the founding partners of FML. I'm here with Bill Claffey. We still have a number of people joining. Again, we've had a pretty good response to the webinar. We really appreciate your support. We're up. We're going to just give it a couple minutes before we get going. As many of you may or may not know, it's been a busy morning, busy evening. There was a 30-plus page document that got released, I believe last night or early morning, and Bill and I have been up early, kind of incorporating as much as we can into the slide deck and into the discussion points. So we'll have up-to-date information. We're excited about the ability to present it. It has created a lot of change, so bear with us in the middle of the presentation if we're a little bit off of our rehearsed game there. Just a couple of reminders that I've published a couple of reminders in the Q&A box about we will be publishing the slide deck. We will be publishing a link to the webinar, so you can replay it if you you care to do so. You can ask questions in the Q&A box, and Bill and I will do our best to respond either privately or discuss them verbally on the event here. And if you're having any problems seeing the most recent slide, please hit the live button on your screen and follow the instructions on the published note that I've done. And if for some reason you're not hearing the audio, I've had a couple people reach out to me. You may need to log back in to the event. Sometimes very few individuals have a hard time hearing the audio for Bill and I. So again, it's about 11:02. We still have a number of people joining the event. We're going to give it a couple of minutes. As we wait, just give a little bit of background. Bill and I have been doing the webinars for a couple of months now. Bill's one of the partners, and he will introduce himself. I'm the founding partner, or one of the founding partners of FML. We are a full-service firm headquartered in Glastonbury, Connecticut. We have a full office out in Enfield, Connecticut, and we have satellite offices in New Haven and Stamford and across the state. We 13 partners, over 80 people, and have really taken a strong interest in providing our expertise on the PPP loans and the COVID response by the government. And we have a full page dedicated to all of our updates on our website at www.fmlcpas.com. So please go online, and if you have any questions, it's a great place to start. And then please don't hesitate to reach out to Bill or myself. We are pretty good shape here, Bill. I think we're going to get going. It's about 11:03. Again, really appreciate everyone's support. And with that, I will allow Bill to introduce himself, explain what we've been doing for the last 2+ hours this morning, and we'll get going and hopefully answer a bunch of questions for you guys.
Great, thank you, Frank. So as Frank mentioned, if any of the folks joined a couple minutes late, there was some new guidance that came out. I saw it first thing this morning, might have came out late last night. So we've been working kind of furiously here to try and get our slides, which we had a nice kind of tight slide presentation. Thought we might get it in under an hour, maybe 45 minutes, but we had some new things to talk about. So, and we've incorporated as much as we can into these slides, but and so if there's more material as we go through kind of a second run through the new guidance, we'll update that on the slides, but I think we got 95% of it. Just by way of introduction for those of you who are kind of first-time joiners, my name is Bill Claffey. I'm a partner at FML. I'm on the tax side. I'm an attorney by degree, but I've been working in the CPA business since my law school graduation and bar examination. And as we put together our COVID task force, we wanted to get input, obviously, from a number of different folks. And so from the tax side, we've got both myself and Lisa Saracina from the tax side giving our perspective, and then balancing that out with Frank from the audit and assurance side and some accounting service folks and nonprofits. So we really kind of round out the team there. I do a lot of tax policy and tax controversy work, so I think it fits nicely into kind of this type of review. So we'll dive right in here. You'll see the first slide here. This is just kind of a table of contents. These are the things we want to go through. Like I said, there were a lot of last minute changes this morning, but we want to talk about, for those of you that I think the last time we did the webinar, Frank, correct me if I'm wrong, I think we did it after the PPPFA, the Flexibility Act, had been passed, but the application had not been published yet, and certainly this new interim rule, which was published this morning, obviously wasn't published. So we're going to try and hit on. Go ahead. We're going to try and hit on
that's right, Bill. The timing's right. Yep.
Yeah. So we're trying to hit on the key concepts that came out kind of post Flexibility Act, and then after, Flexibility Act, but then incorporating the applications, what those said, because those gave a lot of good guidance, a lot of good clarity to the Flexibility Act, which, if you attended our prior webinar, was 2 to 3 or 3 or 4 pages, and really kind of just superseded a bunch of provisions that were in the original CARES Act. So we're going to talk about the loan forgiveness application, some of the logistics that are inherent in there, and like I said, there were some very key revisions that came out this morning. We're going to talk in a little bit of detail about the 24-week option, what that was and what it is today, and those two definitions were very different in the last 24 hours. We'll talk about the form 3508EZ. So that's the new EZ form for those of you that can use that. And we're going to talk a little bit of detail about the new safe harbors, the pre-COVID activity safe harbor, and then this rehire safe harbor, which is really just a little bit of a revision to the prior safe harbor that was out there. And then we're just going to clarify this whole 60% payroll concept. As many of you know, the Flexibility Act reduced the threshold from 75 to 60%, but there were some questions as to did that require you to spend 60% or otherwise no loan forgiveness? And so we've got those questions answered. Okay, so let's get into the logistics. First thing that we note here is the deferral period. Now we talked about this on the Flexibility Act. The deferral period. So you've applied for your loan. You probably applied at some point in April or May. You may be kind of coming up. You may be completed with your PPP loan covered period under the 8-week option. And then originally under the CARES Act, you had a deferral period of 6 months. Well, now that deferral period is up to 10 months from the end of your covered period. So if you had a covered period that ended on June 23rd, you're going to have 10 months from that point to defer repayment of your loan. And Frank, you and I talked about this morning. It kind of goes into the last bullet there. What you've got this deferral period for 10 months, and then you've got a loan forgiveness application concept that really got kind of flushed out in this new interim guidance that came out. Originally, we were kind of thinking you had a 10-month period to apply for loan forgiveness. But if we just jump right down to the last bullet there, you'll see that there's a provision in the new interim rule that says that borrowers may also apply at any point after the end of their covered period or alternative covered period until the period of the maturity date of the loan. Well, that could be 2 years if you've got a loan before June 5th. It is 5 years if you got a loan after June 5th, and you are allowed to negotiate a maturity date of 5 years with your lender if you got a loan before June 5th and you had the 2-year maturity period. So Frank, I don't know, I'm gonna jump this over to you because I think you said it pretty well with regard to you've got the deferral period of 10 months. That seems to be aligned with when you'd want to apply for forgiveness, right? You don't want to start paying back the loan and then apply for forgiveness, but yet the new guidance allows you to do that.
Yeah, I agree. I think the guidance was confusing when we read it. We just assumed that you had 10 months to apply for forgiveness, but it clearly states you can apply for forgiveness at any point, and that means you can apply before your covered period ends. I think that's one of the new clarities that you'll go over here, Bill. But it also talks about you can apply after your covered period ends until the maturity date. So in theory, if someone has a delay for one reason or another, and they start having to pay their loan down because the deferral period is 10 months. So for 10 months, you have no payments due, but after 10 months, you will start having to make payments. But that does not mean, based upon what we're reading, that you can't still apply for forgiveness if for some reason you feel like you have now supported some aspect of forgiveness in your loan process. So a little bit confusing as to why people would want to wait past 10 months, but it's clearly available based upon the new guidance. So.
Yeah. And another little interesting caveat on that concept, and it was in the original write-up that we put on our website, is that unless it got updated this morning on the form 3508, which is kind of like your long form forgiveness application, and then the 3508EZ, which is your short form loan forgiveness application, you'll see in the upper right hand corner is an expiration date of 10/31. I don't know what that means. I don't know why that's in there. It certainly doesn't make any sense based on the ability to apply within 10 months, or the ability, and certainly the ability to apply by the end of the maturity date. What would happen if you filed after the 10-month period, but before the maturity date? Potentially, would you have only a portion of your loan forgiven? I don't know. I would expect the SBA may get some comment on that sentence within the new interim rule, and it'll probably have to provide a little bit more clarity on that whole concept.
Yeah, I would think
doesn't make sense.
Yeah, I would think that any amounts that you're paid at that point would probably remain paid, and any amount that's left would be forgiven. But again, we're making a lot of assumptions here. Hey, Bill, yeah. I think I know the answer to this, but the interest doesn't start accruing until after the 10-month deferral, or does it accrue during the 10-month? I can't remember. We've been focused on so many things. I thought it was an interest-free until 10 months out, but I can't remember.
Yeah, let me check that, Frank. I thought it accrued from the date it was deferred.
All right, we'll get back to you on that. That question was asked, and we'll clarify that point.
Yeah. Now, if you apply for forgiveness and the loan's forgiven, the interest is also forgiven. So that would kind of lead you to believe that the interest, accrues on the disbursement date. Yeah. Okay, let's go up to the second bullet, because this is really kind of the big meat and potatoes that came out with the new guidance. Okay, so once this Flexibility Act had introduced this 24-week period, I was on the phone with many clients talking about, where are you in the process with your loan? When did you apply? Where are you now? If you applied super early and everything kind of stayed the course and you were able to take advantage of the cash and the accrual concept for payroll, we found that a lot of businesses were getting toward the end of that loan, and they were fully able to exhaust the proceeds. But not all businesses. Some businesses had to furlough some employees, and they did so, even though they had gotten a PPP loan. So the question became, well, we've got this new 24-week period. What do we do? Do we elect for the 24-week period? How do we elect for the 24-week period? And there was really no guidance on that. There was no form that came out requiring you to elect. And so we had always advised clients, well, you can kind of take this wait and see approach, but it looks like you're going to have to go either 8 weeks or 24 weeks. And if you were on the phone with me in the last week and a half, I probably told you that. Well, the new guidance that came out this morning basically states that you can apply for forgiveness at any period, including the periods we discussed, maturity and 10 months out, but at any point during your covered period. So the way that I read it is that if you continue to kind of go through and say, hey, we still have 15-20% of our loan that we want to spend, well, that's great. Now it looks like you can continue to spend that for 11 weeks, 12 weeks. And when those funds are exhausted, you can apply for loan forgiveness at that point.
Yeah, Bill, just to clarify, because I think you and I ran around this a little bit long-winded, but at the end of the day, we're getting questions, and I think it's just a point to clarify. If you have an 8-week period, you applied under an 8-week timeline, you can run it out for 10 weeks and then apply at any point. You don't have to wait until the 24 weeks is up, right? I mean, I just want to be very clear, because I think we may have confused some people there. At the end of the day, the way the guidance is written now and been clarified over the last 24 hours, you can apply for forgiveness at any point. Now there are some caveats to that, and Bill will kind of go over. So if you have calculated some sort of a salary reduction and that salary reduction is more than 25%, you have to take that whatever is greater than 25% in your salary reduction, and you have to run it out for the entire 24 weeks. So when you do your calculation and when you read the guidance, it's very clear. So if you have a a $50 additional forgiveness above the 25%, when you go through your calculation, that $50 gets applied through all 24 weeks, even if you're applying for forgiveness after week 12 or 13. Very important concept to understand that they're letting you go through a process of applying early. But if you haven't alleviated any salary forgiveness or gone through a safe harbor process and anything like that, and you basically have a salary forgiveness above salary reduction above 25%, you need to run that out and calculate that for a full 24 weeks. So, Bill, I'll turn it back over to you.
Yeah. If there were some questions coming in on the chat, I want to be very clear. Just like Frank said, the new guidance allows you to apply at the 12-week mark, at the 13-week mark, whatever, at any point between 8 and 20, actually at any point during your covered period, whether that's 8 or 24 weeks. So that's that clarification that came out this morning is maybe the confusion came in because I was kind of discussing how we would have discussed this yesterday. We're we're like in a different world here on the 23rd than we were on the 22nd. As of today, the way the guidance reads, you can go and you can apply, at any point. And that is going to be truly beneficial to almost everybody that I talked to that said, hey, I was able to spend 90% of my loan proceeds and I'd like to spend the additional, 10%. Let's say it's $1 million loan, right? I'd like to be able to spend the additional $100,000, but I don't want to have to retain employees for 24 weeks. And again, yesterday and prior, I think the overwhelming viewpoint was, well, that's kind of a balance. You're going to have to make a business decision based on that concept. On the 23rd, that guidance has been, that SBA has clarified that point and said, no, not even like clarified. They almost kind of changed the viewpoint a little bit, and they're going to allow you to, spend the extra $100,000 and apply in 3 weeks, 3 weeks later, at week 11 or week 12. That's a significant point, and I think everyone on this call and all borrowers should be very aware that that 24-week option becomes a lot more attractive because of the guidance that came out this morning.
Yeah, Bill, a couple things. We're throwing a lot out there, and I think we're doing a great job. But as we step back, when we went through the new guidance this morning, what we saw was any salary and hourly wage reductions, if you apply before the end of your 24-week process, need to be calculated and pushed out to 24 weeks and brought back into your application, so that your total forgiveness would be reduced by your 24-week period, blown out by your total salary reduction over 25%. What we didn't see in there was, to your point, Bill, was the FTE reduction. So if you had FTE changes between your measurement periods, it doesn't tell you need to go through and recalculate your FTEs, but you would have to understand that if you did have a large FTE reduction when you're measuring your loan from the measurement points that we've all kind of become aware of, right? And when you apply for your loan, you still have to go through your application, your calculation process to determine if you've had an FTE reduction at a level that would limit your forgiveness.
Yeah, agreed, right? So if you chose let's take the two scenarios, right? You choose the 8-week period. You've got, John Doe has a salary reduction of, when you compute it out for that 8-week period, that was a salary reduction of $100 a week, right? So let's say when you go through your loan application, your forgiveness application, for an 8-week period, that would be an $800 reduction in your loan forgiveness, right? And let's just keep a simple example with one employee. That's a salary reduction. if you applied in week 13, you would still look at that salary reduction. Let's say it's still sitting at $100 a week, but you now have to reduce your loan forgiveness amount by $2,400 because that $100 times 24. You need, even though you're applying in week 12 or 13, you have to kind of like, you have to project out what that salary reduction is for 24
weeks. There's a good example in the guidance regarding that, Bill, just to clarify.
It's a perfect example.
Yep.
From an FTE count, you're going to apply in week 13. You're just going to do your FTE count over 13 weeks. Now that may give you a better result. That may give you a worse result than 18. And so I think you still, every borrower should still kind of consider that. If you bleed the loan out for another 3 or 4 weeks, but you also, terminated half your FTEs between weeks 9 and 13, you might not have a great answer, because now those FTE reductions for the 13 weeks up to the date of loan forgiveness application, they're going to go into that calculation. Now, if you terminate folks you apply in week 13, you terminate folks in week 14, 15, all the way through the end of the year. The way that I'm reading it, those terminations after the loan application, forgiveness application is submitted, those are not going to count against your FTE.
Yeah.
Nor will further salary reductions, right? You just have to take the salary reductions you had in the covered period, and you just have to project them out over a 24-week period.
Yeah, a couple things here. Do people have to go through a process of applying or asking for the 8-week to go to a 24-week? Bill, I don't think so. It's in the application, right? The application process has clarified that, right? You just determine.
Yeah, there's I thought they would come out with some sort of a form. They have not. So right now you pull up your form 3508 or your form 35EZ, which we're going to talk about in a bit here. And you just fill out a covered period or an alternative covered period, and you're going to put a start date and you're going to put an end date. And that, and as of today, right, that end date could be 9 weeks or 10 weeks or 11
That's right.
weeks.
It all plays together now as people start realizing, if you can ask for forgiveness or you can apply for forgiveness at any point, your covered period ultimately maxes out at 24 weeks, but you can make it whatever you want. And you can go in and you start putting your covered period dates in there as long as you're not exceeding 24 weeks. I believe that's how it's all playing out. Second question, Bill, was just on the 25% reduction, saying if we reduced a salary by more than 25% because they were capped at $100,000, does that count? Just to clarify, you're not taking any salary reductions for people above 100 grand in salary. So if you had someone making $150,000 and you cut them to $100,000, none of that reduction is going to count in your process because you're capped out at 100,000 for those employees.
Okay. And in fact, and I'll go one further there, Frank. If you had a person who made $150,000, you could use their salary to $1, and that would not, because that person is not I'll use the term qualified employee for whom salary reduction counts. On the application, on the old application, on the new application, you're going to see once you start filling that out, you're going to put people into two different tables. You're going to have one table is going to be employees that did not make $100,000 in 2019, and the other table is going to be people that did. And the people that did, there's not even a column that allows you to calculate salary reductions. So so it's pretty. One question I kind of, as we're sitting here, and Frank, I don't think you and I talked about this morning, but it's interesting, and I didn't see it in the guidance. And we're going to get into the caps on on employee compensation caps and how that all moved, and maybe we can save that for that conversation for that. But I just want to bring it up here so I don't forget about it. How do those amounts move if you apply after 13 weeks? We have the 15,385. That was the number we were always working with. Then we have the 46,154 for a 24-week period. Well, let's say you apply in 13 weeks. I would think that cap would be prorated for that period because you kind of have a new covered period, but I don't know that they clarified that in the guidance.
Yeah, it's a great question, Bill. Great question, and I think as we kind of digest some of the new guidance that came out last night, we're gonna maybe hopefully get some additional guidance that we can bring into a new webinar. Hey, Bill, people keep asking there's a couple questions as to where we're getting the new documentation that came out last night, because as you and I have discussed, getting information directly emailed from treasury.gov or any of that doesn't work. You got to search it out. Just clarify for people really quickly where they can go or where you go normally to find that information, Bill. Do you go right on the Treasury website at this point?
Yeah, I go right to the Treasury website, and that website, and maybe we can put a link into it when we send this out, Frank.
Yep.
Have Courtney put a link in there. That's the best source that I've seen. It's fairly well organized, and it's I struggled as well, back in April timeframe trying to find this stuff. It just seemed like it was all over the place. But the Treasury website is pretty good.
Yep.
And it lists them chronologically, which is nice.
Okay. So we're going to keep moving here. Bill, the deferral of 10 months, it is automatic. I'm just going to say that out loud. A question came in. You do have 10 months. You get 10 months automatically. You don't have to apply for it. You don't have to request it. You will be contacted by your lender upon 10 months expiring if your loan has not been forgiven in entirety for a payment process to occur. And again, remembering, if you're prior to June 5th, you're on a two-year repayment process. If you're after June 5th, I believe I have that date right, you're on a 5-year repayment process, and you can apply for a 5-year with your lender if you've been grandfathered into a 2-year under the original loan application. But that's not an automatic request. It's something that needs to be negotiated with your lender, so you will have to go through a process of reaching out individually on that. Okay, Bill.
All right, I think we can go. Okay, so let me see. So we're at the, okay, so just a little bit more on the logistics. If you guys haven't seen the forms, there are now 2 forms. You've got the 3508 EZ. Just think of like an easy tax form. It's just a shortened version of it, of the loan application form. And this form is for people who don't, if you guys looked at the older version of the loan forgiveness application that was published maybe a month ago, you probably saw that there was a check the box in there that said if you don't have any reduction in employees, FTEs between January 1st and the covered period, check this box, and you don't have any salary reductions, check this box and don't fill out any of the FTE quotient or salary reduction boxes. Well, now they've created a form for that. And so that's the easy form. So if you don't have any FTE reductions between January 1st and the end of your covered period, no salary or hourly wage reductions, and you meet, and there's a new safe harbor that gets introduced, that you meet in conjunction with no salary or hourly wage reductions, then you can go and you can use this 3508 EZ form. The long form, the 3508, that's the form you got to fill out when you have, when you've got FTE reductions or FTE counts kind of all over the place. You need to go through that process and, identify, your FTE count in the numerator, your FTE count in the base period, which is, either of the February 15th to June 30th, 2019, or January 1st to February 29th of 2020. If you had salary reductions for qualified employees, you're gonna have to go through that process of filling out that longer form. It's really actually not that much longer, but those calculations can get a little bit, get a little hairy trying to go through all those numbers. And we've got the new safe harbors that are actually a part of both forms. So this slide, Frank, I think we covered a good portion of that, right? So we've got, I think the question came in, how do you elect it? Well, you just fill it out on the covered period. We talked about the maturity of the loan, the 10 months. We say within 10 months to get full forgiveness, because it appears if you applied after 10 months, although permitted by the guidance, you would have already paid back some of the loan. So potentially you're not going to get 100% forgiven. Again, I don't know why anyone would do that, absent some sort of a, very unique circumstance. We talked about the interim rule, and if you've got the salary and hourly reductions, even if you apply after 13 weeks or 10 weeks or whatever it might be, you just need to take that number and project it out for 24 weeks and include that as a reduction. Okay.
Yeah, I mean, so really just looking at some of the questions, Bill.
Yeah.
When we talk about FTE reductions, does that include if employees were terminated for cause or left voluntarily? Absolutely not. There's been clarification on that. That gets, when you go through the application process, you will add those employees back in a manner that they do not count when you do your FTE count comparability. So that hasn't changed. And I believe when we apply the limit of 100K salary, is it up to 100K or 100K? Seems like that always comes up when limits are applied. I mean, I think at the end of the day, it's up to 100K, right? I mean, you have up to 100K. Anything above $100,000 is the amount that we're talking through in our process here.
Yep.
Okay.
Yeah, can you just go back one? I just want to reiterate the one point. This is kind of where I was going to bring it up. So I think we talked about, no, we don't think we talked about this in the Flexibility Act webinar because that came out in the application. So there was this question. Okay, now we've got a 24-week period. Now you seem to have anywhere between an 8 and a 24-week period. And in fact, I think you and I talked multiple times after the Flexibility Act came out, like, why didn't they just say up to 24 weeks? And now we seem to have that in this interim rule. But employee compensation, that cap change, the 15,385 that we had always talked about, if you choose the 24-week period, they specifically provide it in the application, and they specifically provided in the interim rule about how employee compensation is capped at 46,154, which is just their 15,385 times 3 with a little bit of a rounding there. And the question that I had brought up earlier was, okay, what if I apply in week 14? Do I further prorate that number? To use your kind of feedback on a lot of this, Frank, that seems logical. Although I don't think that's said anywhere specifically that you would. I don't think it specifically states that you must prorate it if you apply before. But I think you get there when you kind of wrap all of the guidance in, you're kind of defining a covered period. At that point, I think we're waiting for a little bit more on that. But I guess until then, I would probably consider that concept of prorating it for whatever it might be, 13 or 14 weeks or 12 weeks or 20 weeks, whatever you end up applying.
Yeah, but I think the main point here is if you run the 24-week out, your employee compensation cap now is 46,000 and change.
Yep.
And then your owner cap is maxed now at 20,833, I think. And I think we're going to get into a pretty hefty slide next, Bill, that talks about some of the changes there as well. But the guidance kind of continues to reiterate that owner compensation is going to be treated much differently, even if you're a worker, an employee owner. They do not want this to be perceived in any manner as being a windfall for owners, businesses, which is why the $100,000 cap happened, and also why they continue to limit owner comp much lower in a manner that's capped out from an employee perspective. So I think the question, and Bill, it's funny, I guess, for us, but maybe not for everyone else. But as we continue to go through this, and we're so new to the guidance that came out today, but as we go through this process, we continue to raise questions, and I think that's why we're seeing guidance getting pushed out quicker now than normal, as people are now applying for forgiveness, because some people have been through their 8 weeks. Now they're going through the application process. As they continue to change the rules, they continue to need to clarify why the rules have changed and how do you apply them. And I think this whole, hey, I can apply at any point now, has created a little bit of uncertainty as to, okay, now that you've changed the caps for employees, how does that apply through my, if I go from 8 weeks to 14 weeks or 20 weeks and not all the way through? So bear with us. We're reacting as quickly as we can, and I think we'll do our best to clarify that. So please continue to check for our emails that we shoot out to people, as well as our website. Bill, back to the slide deck.
Yeah, and just a quick point on the logic behind that. I think it's fairly obvious, but you going the 15,385 for the 8-week period was always the $100,000 annualized for 8 out of 52 weeks. The 46,154 is $100,000 annualized for 24 of 52 weeks. And as Frank mentioned, because they didn't want owners to get windfalls, and they actually provide an example in there of how an owner could get a windfall by terminating an employee and then taking, more compensation than the SBA believes is necessary. For owner comp, they cap it at $20,833 because they look at that as 2.5 times your average. So that's how they get to that number. If you go through the guidance, and I think, Frank, it was on page 13,
Yep.
You'll see that, and we've basically just taken everything that they had there and just kind of put it here on one slide. I think it's important because through these webinars, we've always talked about different ownership types, and it got a little bit ambiguous sometimes, but I thought this guidance actually did a pretty nice job of going through each type of ownership structure and telling you how owner employees get capped. And so you can see it right there on the slide. If you're owner of a C Corp, you get your 2833, but you also get to include the funded healthcare and the employer funded retirement, just as any other employee, right? If you've got an employee that's capped at the 100,000, whether you're choosing 8-week or 24-week, is capped at that number. We always knew you could include healthcare that the employer provided to that employee, and any kind of retirement contributions the employer made for that employee. Even if he made over $100,000, you can include that on top of the old 15,385. That's allowed for C Corp owner employees as well. S Corp employees, again, you've got your 2833, or just understand that you don't automatically get the 2833. You do have to look at you have to do a kind of percentage of your 2019 comp, and if that's lower, let's say you made $50,000 in 2019, your cap is not going to be 2833. It's going to be 10,000 and change.
Yeah, just to be clear, we got some questions coming in on that, Bill. Just so we're clear, it's not the less. It is the lesser of the two. So 20 is the cap. 20,000 is the total cap.
Yep.
But if your calculation based upon your entity type is less than the 20,000, based on the 20%, 20.83%, you have now established a lower cap that you can take for an owner at that point. So
yeah, and when we publish these, this like I said, this information just came in, but when we publish this, we'll probably just put the lower of these two variables. But if you notice, S Corp employers, you can include the employer funded retirement. You can't include the healthcare for S Corp owners. Schedule C, again, you got the 20,833 or 28.8, the lower of 20,833 or 20.83% of the net profit from 2019. And again, the healthcare costs, retirement costs are not forgiven in that example. And then we get down to general partners, similar concept, but then you're looking at the 20,833 or 20.83% of your 2019 net earnings from self-employment, and then you've got this other calculation which has been out there since I think the original forgiveness application was submitted, where you're reducing that by your 179 expense and your unreimbursed partnership expenses and depletion. You're multiplying it by 92.35. I think the logic is why the logic of the 92.35 is in the guidance. But again, you're not gonna add on healthcare and retirement costs, even if the business is paying those costs, for the partners.
So Bill, a couple things here.
Yep.
If you're an LLC, question is, if you're an LLC filing as an S Corp, do the limits apply? Yes, right? I mean, that's you still have to establish your owners, right? Of
Right.
either. Yeah.
Yep.
And then do they define owners? It's a good question. Someone whose name I recognize asked whether they are defining an owner somewhere in the guidance. I don't remember if that was the case, but I thought it was over a certain percentage, right, of ownership.
Yeah, I mean, all the ownership, I mean, that got discussed early on. I know at one point, during the application process of 20% or more owners. I don't recall. I don't think it was in yesterday or this morning's guidance.
No, it was not. Absolutely not. I think we're gonna, for the individual that asked that question, I think you got to go back to the original guidance and determine what they define as being an owner or not. I think obviously it gets a little harder in a C corp, but from my perspective, we just have to go through that process and get back to that question. So Bill, anything else on this slide before we move on?
No, I just wanted to point out the last note. Just be aware that if you're going with the 8-week option, everything on this slide is the kind of the 24-week caps. But if you're using the 8-week option, then those numbers all come down. So just be aware of that. Okay, so now we get into the 3508EZ. So here are basically if you look at the form, it gives you like a checklist, and you have to check one of the 3 boxes in order to use the form. The first check the boxes if you're self-employed, sole proprietorship, or independent contractor. You don't have any employees, so therefore none of this FT quotient stuff or salary reduction can really have any impact on you. So you can use it in that concept. Two is really kind of the old check the box. That's the way I see it. I'm an employer, I'm a business. I didn't have any reduction in hourly wages. I didn't have any reduction in FT. I stayed the course 100% from January 1st. And so if you have that, if you have both of those items, A and B, then you can use the Form EZ. And you don't need to meet obviously each one of these tests. You need to only check one of the boxes. And the last one introduces the new concept that came in the Flexibility Act. Okay, so part 1, no reduction in salary or hourly wages of qualified employees. So that's that 25% that Frank had mentioned when you compare it to Q1. So qualified employees, again, if you have reduced an employee who was $150,000, that's not a qualified employee. So you can have reductions. They just can't be to qualified employees, which are employees that made under $100,000. So you can't have that. And then you also fall under the brand new safe harbor, which is the borrower is unable to operate during the covered period to the same business level. I call it the pre-COVID level of February 15th, due to the requirements of Health and Human Services, Center for Disease Control, and OSHA related to social distancing and sanitation and those matters. So we have to have both, though, right? So if you had a reduction in salary or hourly wages, then based on the way that it's written, even if you were significantly impacted and certainly fit within B of 3B, seems like you can't use the EZ form. Now you might have to go through a long form. You might get other safe harbors that apply that don't impact you, but you're gonna have to use the long form to get there.
Yep. A couple things here, Bill. I mean, listen, I think there's a lot on this slide, more so than we normally do, but I think we'll break it down a little bit. But once you start looking through it, a lot of words, but pretty basic concepts as to when you can jump yourself into this EZ form versus when you'll have to go through the normal application for forgiveness.
So yeah, so you can see here, I try to kind of take the 3 reasons, right? The 3 bases that you can check the box here, and try to break them. And I kind of view it as like 2 different, there's 3 tests there, but the first 2 are kind of like they just kind of restate or reemphasize what was in the old application, which is I didn't have any employees, sole proprietor, or I didn't have any reduction, right? So I didn't have any reduction. So I had 100 employees on January 1st. I had 100 employees at the end of my covered period. I didn't touch anybody's salary. So you don't need to go through that whole process. And that process is both time consuming and it's tricky, those FTE calculations. And so, if you didn't have that, you didn't have it. And I've talked to a number of clients that didn't have it and it's like I said, it could be a time-consuming process. If you didn't have it, you use the easy form, and you don't have to provide any of that data, any of those calculations.
Yeah, and I think one of the things that's coming up already, and I think we'll get to it more, is you still have to support your conclusions and documentation. Yes, yeah. I mean, we're still gonna there's still gonna be a need in the EZ form to supply certain payroll data and certain other information, and we'll get into that a little bit more. So let's not make the assumption that because we're checking the EZ box that we're just gonna make a general representation as to why and move on. The bank lender will require information, and that's been outlined in a little bit more clarity on the guidance that got released today as well, and we'll get into it. So.
Yeah. Okay, so let me get into this third one, and this incorporates that whole part B of this one, the inability to operate. So that was a new safe harbor that came in through the Paycheck Flexibility Act. Since that date, Frank and I have debated and talked about, well, how is this going to get applied? There's language within the act that talk about a proportionate reduction. And so we kind of talked a little bit about what does that mean? How are they going to apply that? Which guidelines, et cetera. We also talked about whether it's going to be a direct, are they going to apply it direct or indirect, right? And so the conversations we had, and I've had them with multiple clients, are, you're a restaurant, right? You're a restaurant operating in the state of Connecticut. You were probably shut down for a lengthy period of time. You had a very direct impact to your business, and you did not have the ability to operate at pre-COVID levels because at a minimum because of state guidelines or guidelines that were issued by Governor Lamont. The guidance that came out this morning, you read it, they use the term directly or indirectly, and I think it could be read in two different ways. One is you as a business can be either directly or indirectly impacted. So you are directly impacted if you're a restaurant. You are indirectly impacted if you are in the supply chain. I think you can read that, Frank. Correct me if I'm wrong. I think that's the way we discussed it today.
Yeah, I agree. It's unfortunate because they have an example in there, and you pointed that out, Bill, that unfortunately I thought clarified more of a direct impact than an indirect. They had an example where you had both online shopping and, storefront business, had both business online and storefront, and as a result of the storefronts having to be closed for periods of time, they related that to the example of direct and indirect. Our examples tend to get a little bit more, it's not the storefront, it's whoever supplied the food and the beverage into a restaurant, or someone who's applying goods or services into that restaurant or into that storefront that cannot do their job. I think we, based upon the guidance and the way it's written, I think there's a lot of latitude now in being able to document or try to document why you think you apply for or qualify for reason 3, here.
And the other area, it uses that phrase directly or indirectly at least 2 times. And so one time is what we just discussed, where I think you've got a direct or indirect impact to the business. And then they use it again, and I think they're going down the path of direct or indirect compliance. And so they actually give some logic behind the rule, and they state that state guidelines are often based off of CDC and Health and Human Services guidelines. And so I think in the example they give, Frank, right, with that retail and online store, they actually state that the state governor shut down the retail store, and so they would be eligible for this safe harbor. So I think you've got direct and indirect based on the impact of the business, and direct and indirect based on states following those guidelines and issuing, like the guideline that you may have followed might have come from the governor of your state, but it was indirectly related to CDC guidelines that are being published as well.
Yeah, so let me give an example that someone asked a question that I think is it's good. It's a good one to debate. We may not get to the right answer, but I think this is what companies are doing, and they like to hear us debate it, right? So if I had an outbreak in my office or my business of COVID, and as a result, I lost, access to 5 people because they contracted the virus and now they need to not work. I don't believe that is what they mean here, because that's not, it's not like a general, in my opinion, Bill, and I'd be interested in hearing yours, broad brush. It's just the inability to operate due to OSHA, HHC, or CDC compliance. So really narrow-minded, I can say no. But if I broaden my thought process out, Bill, I can say, well, those people are required to be quarantined and they can't go back to work for 10 days, 14 days, based upon certain guidance that's been released. You can maybe apply that, right? So that's in my 5-minute exercise, I've changed my opinion within just applying it through, right? I mean, so you can apply that logically there.
Yeah, I mean, it's when that came out through the Flexibility Act, my initial response was, how are they going to deal with this? How are they going to administer it? How are they going to audit it? How are they going to review it? I'd kind of gone back, and I'm sure you and I talked, Frank, but are they going to issue some sort of checklist and say, if you are in, if your business falls under one of these NAICS codes, check the box and yeah, you apply. They did not do that. And I'll be very clear, they did not do that. They kept it very open to interpretation, I think, especially with this direct or indirect kind of language they use in the interim rule. And the documentation that you need to provide, I think it's maybe in the next slide, is really just is you need to provide financial information and a list of the guidelines that didn't allow you to operate at pre-COVID levels. But they didn't really give you much more than that. I mean,
let's do this, Bill. Let's keep going, and because we're about 10 minutes out until 12, and I want to give people the opportunity to get enough of our presentation, and then if they're able to stay on to hear some of the back and forth on the questions, that's great. But I want to make sure we get to the last couple slides. So.
Okay. All right. So we got the the new safe harbors that came out. This again, the guidance gives you a little bit more clarity here. We just talked about the inability to return to pre-COVID levels. Then you've got this inability to rehire an employee or similarly qualified employee for an unfilled position. This is really a revision of a safe harbor that came out maybe a month ago, where I think that was part of the safe harbors that came out related to rehiring employees, providing an offer, the employee rejects the offer. Someone asked a question before about for-cause terminations, voluntary resignations, voluntary requests for reduction of hours. All those safe harbors came out. I forget the exact date, but let's call it about 30 days ago. Then this comes out in the Flexibility Act, the second bullet here, and I think it's really just kind of a restatement of that. But it also goes into this concept of not being able to hire a similarly qualified employee for the unfilled position. You can read that a couple of different ways too. I think the easiest way to read that is you are, and it makes sense when you look at the documentation that they ask for. But it's basically, I have an unfilled position, I'm trying to hire someone, and I can't hire anyone, right? Either because for whatever reason, they don't give you the exact reasons that you need. You just have to provide evidence that you weren't able to fill the position with a similarly qualified person. Maybe that person doesn't exist. Maybe that person doesn't want to come into an environment that that they don't feel comfortable with. So, the second bullet is kind of a little bit of a restatement.
Yeah, and I think the guidance, Bill, I think you and I went back and forth on this morning. I think the guidance talks about the fact that they didn't supersede it, but they maintained the other safe harbor that was in essence embedded, I think, in the application or something. It wasn't even like sent out in a guide or a interim rule. They kind of just plopped it into the guide, into the application for forgiveness when it originally came out. And I think what they spent a couple of paragraphs in the new guidance that was released this morning talking about why they kept it in, and they still find it being applicable, which coincides with your point of saying it's kind of a repetitive to that last bullet on your on the slide that we're currently looking at now. So
Yeah, I think they referred to it as de minimis. I'm not really sure.
yeah, exactly.
Yeah. Just one point on that last bullet there, Frank. So that was part of the Flexibility Act. So when you got your FTE and your wage reductions and all those various items, the application itself, and this comes from the application, basically says, so kind of go back in time, right? We had the 8-week, then we had the 24-week. Then you kind of didn't. It was a lot of questions as to, well, when do we have to? This is kind of the third bullet is the original safe harbor, the one that used to be June 30th. And so when the application came out, it uses this exact language, which is why I put it in there and why I put it in bold and caps. Those restorations, I guess I'll call them, right? So when you have, I had a reduction in my full-time employees. I had a reduction in my full-time employees during the covered period, but I was able to basically disregard that calculation if I met the original June 30th safe harbor. So that was kind of our original date. Well, the Flexibility Act pushed that to the 31st of December. And that safe harbor requires you to have a reduction between February 15th and April 26th. That's still good. That still has to happen, right? So I had 100 employees and I had 95 on April 26th. Okay, so now I've met like the first piece of this FTE reduction safe harbor. Then at this point, as long as let's say I've got a 5 over 100 quotient for a reduction, right? I can disregard that entire calculation if I restore those FTEs back to the February 15th level by the earlier of the loan forgiveness application date. So that could be any date, right? As we discussed earlier. And then they use the word "and." For what reason, I don't know. It should be an "or," but they say "and" December 31st. I'm going to chalk that up to a little bit of an oversight on the application and say that, so if you had 100 employees, you had your reduction, you go down to 95. Now you're sitting there, you're going to have loan forgiveness based on FTE reductions. As long as you restore your FTE count back up to 100 by the date you apply for the loan, or December 30, or for forgiveness, or December 31st, then this FTE safe harbor kind of kicks in and you disregard that calculation. Same thing for the hourly and the salary. That's an old concept. I just want to make sure.
Really, sorry, Bill, go ahead.
I was just saying, that's an old concept, and it's, we're kind of at a point where we're trying to just kind of talk about new things here, but everything harkens back to some earlier things, and so I just want to make sure that that whole third bullet there, that's an old safe harbor that always existed in the CARES Act. They just changed the dates on which you need to do that. You need to kind of accomplish that process.
Yeah, it's really important though. I think it's a good point, and it's a really important point that, the third bullet, number 1 there, date of loan forgiveness application, it's a major change.
Significant.
It is a very significant change. So you're not maintaining it as of June 30th anymore, and you may not have to maintain it until December 31st. June 30th is definitely not a date anymore. That's which was originally replaced by December 31st. Now they're saying the earlier of the loan application date and the 12/31 date. So to me, that's a major change to one that we talked about earlier, Bill, which was, hey, if I'm going 24 weeks, now I've got to maintain my employee counts through the end of the year. For some businesses, they're incapable of taking that risk. So as a result, they weren't going to pick the 24 week. They were going to maintain 8 weeks because they felt that the risk of trying to maintain employee levels through 12/31 was not worth the forgiveness concept. So now, based upon what we're seeing, you can maintain your employees through your application date, and now you have a much better chance of going through that process. Now, there are additional questions that come along with that, but really important point that I think we wanted to highlight there.
Yeah. Okay, so the documentation, again, this kind of hopes to answer some of the questions. It's a checklist. I forget which page this was on in the new interim rule, but I thought it was helpful, so we just included pretty much everything that was on that page.
Yeah, first time that we've seen, and Bill, when people go through the actual review of the interim rule that came out, there's a whole bunch of information that was targeted to lenders when you read it. Lenders answering questions that lenders may have in regards to information. And I believe this information that we pulled was not really being read in a way that was for the borrowers. But to me, and Bill, you agreed, this is information that I think you're going to want to understand, that if you're going to apply and have to prove certain levels of availability of workers or inability to return to pre-COVID levels, they clearly are giving you some guidelines by what you should be measuring your ability to apply in that manner with. And they're also requiring you, and again, we've talked about this way back when we had our guest UKS kind of join us, Bill, that if people are not willing to come back, it could put their unemployment at risk. And the first bullet there clearly says that the borrower must let the unemployment insurance office know that someone had an offer to go back to work and refused it. That's clearly going to impact an employee's ability to collect unemployment insurance. So a lot of information in here that may appear a little bit more detailed, and we don't have a lot of time to get into it, but I thought Bill and I both thought it would be helpful for someone to have on a slide as they go through their decision-making process.
Yeah, and that first check mark under the availability of workers, the one you just talked about, Frank, that's new. That's kind of a new kind of. The other things, the written offer to rehire, that was already in there in some older guidance and maybe the application. But that first check mark is new, and and I don't know what everyone's situation is, but you may be past that 30-day period. And I'm not an employment lawyer, so I don't know exactly what all the different, that requirement might already exist. But if it didn't, it's clearly part of the PPP, requirement. So if you have that situation, you need to jump on that right away. This was just a real simple one. And again, we're kind of going back to the Flexibility Act that this got clarified in the application. But when they reduced the payroll requirement from 75 to 60, it was a little bit of uncertainty about, well, if I spend 59% of my loan on payroll, am I going to have the whole thing forgiven, or is it going to be a partial forgiveness? And so the application and the new interim rule, certainly clarify that. I don't think it went in a direction that anyone didn't anticipate, but there were questions. But now, so basically, right now, if you don't meet the 60% threshold, it's going to be a proportional piece of your loan that wouldn't be forgiven. And the mechanic of doing that is just to take your payroll costs, divide it by 60%, whatever number that comes out to, that becomes one of a potential couple of caps on the loan forgiveness. So you'll see when you do the math on that, right? As you go through your application, your loan forgiveness application, that just kind of sits as a cap. And so, and if you spent if you had a $100,000 loan and you spent $50,000 on payroll and $50,000 on rent, you're going to take the $50,000, divide it by 60%, and that's going to come out to a number that's less than $100,000 of forgiveness. Okay, so then this I think might be the last slide, Frank. So we thought this was important, just so you got a sense. And this is just another area where I thought this was probably one of the better sets of guidance that came out, certainly since the Flexibility Act. But it lists out, the lender's exact process that they're going to go through when they're doing loan forgiveness, loan forgiveness review. And as you can see, there's a lot of they have some pretty decent leeway on relying on borrowers' calculations and items of that nature. I'm not going to go through every concept on here, but this is the list. This is literally a cut and paste from the guidance on what their requirements are. The note is ours, but it's in the guidance, and it basically says that if the borrower is using a recognized payroll provider. Frank, do you remember if that was a defined term?
I don't think it was defined. No, it wasn't defined, but it clearly stated that if your payroll documentation that you're submitting into the lender is from a recognized payroll provider, that the lender can basically use that as an opportunity to not review it as much if it was provided in a manner that didn't come directly from a recognized provider, not defined. And I think my point here, and with all due respect to the payroll providers, their reporting has not been, in our opinion, accurate to a level that I would just be taking it and sending it in, unless you're supporting that with some sort of a manipulation of that data in a manner that's clearly recognized that it's sourcing from a recognized provider of payroll, but it's being manipulated in a manner that's supporting the correct application of the guidance, because quite frankly, the payroll companies are doing the best they can, but they can only manipulate their reports in a manner, in our opinion, that get you part of the way there. So.
Yeah, and I know that some of the payroll provider companies, and not even like the, if you look, kind of think of like the big 2 or 3, this was, a secondary. I mean, they are, if you guys are listening, they are providing those reports. Literally, here's your covered period. What are my FTEs? They're some of them are able to generate that report, but as Frank mentioned, I think. I don't know how much. I don't know if you can rely on that 100%, especially if it doesn't give you the answer you want, right? I mean, you want to take a look at that and make sure that it's accurate, and make sure that that everything's getting counted appropriately. Now, if it does give you an answer that that works for you, I mean, it sounds like if it's a recognized payroll provider, the banks aren't necessarily going to be required to challenge that.
Yeah, they're definitely given more leeway to accept it with limited review, and I think that may have been the wording, but I could be getting that slightly off. But
the other thing is that what they're going to give you is just a raw number, right? I had 31.8 employees. They're not going to give you any of the, hey, does this guy meet an exception? Did I, if this furloughed employee, do they meet an exception? Do I meet a safe harbor? I haven't seen the payroll companies providing anything along that way in terms of reports.
Yep.
So, if you do go get the report from your payroll provider, I think you need to really take a look at it and make sure that it's, that it's considering all the different changes you may have had in your business over the last.
Yeah. So listen, I think we've hit the last slide. I just want to thank everyone. We usually will go through Q&A here, but just a couple of things. I just want to thank Bill personally for all the effort in getting the slides updated and making this, kind of even a more meaningful hour. We're pretty much, we rely on Bill and others in our COVID task force to really kind of drive this process. And Bill and I spent quite a bit of time this morning trying to get you to the right place. And we appreciate you being here. FML is doing a number of webinars. We have another one Thursday for those of you who may be interested. We have a guest, I believe it's Merrill Lynch, that's going to present some hot topics and benefit plans, which is being combined with Merrill Lynch and FML. And please, Thursday at 1 o'clock, if you're able to join us for that one. But we will continue to drive through this COVID process and continue to provide guidance. I know there's a lot of questions. We have, I don't know, close to 40 questions in our list here, and some of them go back to sorry, Bill, I may have lost my live feed, so I'm not sure what's going on. But in any event, sorry about that. The slide deck just kind of disappeared on us, but at the end of the day, we do have about 40 questions, regarding what's going to be a proper record for an employee not taking an employment option that was given. Can it be an electronic format like a text or an email? We really don't know those questions. I mean, I think some of those details, really good questions, but really, we don't know. We just don't know the answer to the question. So we've got still about 85 people on the call, the webinar, Bill. So we want to take another question or two. I think, Bill, the last question is a pretty detailed question. Payroll incurred versus paid. This is one of our old nemesis that kind of continues to come up. Seems like you can use both. I agree with that, right, Bill? Without reading the rest of the question, they've kind of expanded that definition. That kind of extends it to say, hey, if it was paid at the beginning of the covered period, you can take it even though some of the payroll may have been incurred before the loan got distributed. And on the backside, it also said that if you have a payroll period that's outside your covered period, but it's paid under a normal payroll process that's immediately following the end of the covered period, that you include both. Correct, Bill?
Yeah, no, I'm in 100% agreement with that. They clearly state that any payroll paid during the covered period is includable, and then, like you mentioned, anything that's paid, and it has to be the next payroll cycle, the next regular payroll cycle. So, folks have that situation. Now, it's interesting though, if you are a biweekly or a weekly payroll provider and you opt to go for this alternative covered period, so you shift everything up so that the first day of your covered period becomes payroll date. I think the example they give you, they say, well, you can still, any payroll incurred after the date, but you shouldn't get there. If you move everything up, you shouldn't get there under an 8-week or a 24-week period.
Correct.
If you get there under a 13-week period, maybe that's where that's going to come in, and that's brand new today.
If we had to close and lay people off, but with PPP got FTEs back to pre-COVID, can we use that easy form? I don't believe so, right, Bill? Because you're using the safe harbor to get there, right?
Yeah. I think you have to have
no FTE reduction.
Literally no reductions. Yeah.
Yep.
Now, well,
it's a good question though, Bill, because at the beginning and the end, you don't have any employee reductions. How you got back up there, right? Yeah,
I mean, let me put a little caveat on that. If you lost an employee, like if you lost an employee during the covered period, but then hired 2 people on the next day, right? So ultimately your FTE count hasn't changed, right? Between January 1st and the end of the covered period count. I think you're okay in that situation. I don't think you have to have the exact same subset of employees.
That's true. That's true. It's a great point, Bill.
Yeah.
Right. So if you're back to that number, and you, in theory, haven't had any number reduction, doesn't have to be the same people.
Right.
I think you can apply. I mean, the question, if you had a few employees resign, that's another point, right? So I had a couple of employees resign, but I'm not counting them as reductions. But in that scenario, you do have a decrease. You're using the safe harbor to get back up to the number. I believe you cannot use the easy form if you need to prove that your reduction is now being relieved because of a safe harbor.
Yeah, I agree with that. Once you get into any of the safe harbor concepts, that you gotta go to the long form.
Yep.
Or the exceptions. I guess that would be more of an exception. You're saying, well, I had 10 FTEs. I went down to 8, but 2 of them voluntarily resigned. So I think that still fits in the area where you still have to get that on the long form.
Yep. Just to reiterate, we are going to send copies of the slides out. Debbie had a question here. Before the reduction in FTE was based on 21520 count, is it now FTE count as of 1/1/2020?
Can you repeat that? I don't know if I understand. I'm not sure if I'm catching.
Yeah, I think it's a little bit too vague. Before the reduction in FTEs was based on 2/15/2020 as the measurement date, right? That was the.
Yep. That's kind of like that's the date you have to go back to when you try to apply the safe harbor.
Right, but it's correct. Is it now? Is that date moved to 1/1/2020? The answer to that is no, right?
Right. It's not 1/1/2020. The only reason 1/1/2020 comes in is for the easy form, and that will check the box that was on the old form, basically saying I haven't, nothing's changed, and I have the same FTE counts from January 1st. So therefore, and conceptually, if you think about that, if you didn't have a change between January 1st and the end of your covered period, you're going to choose, right? You're going to choose January 1st to February 29th as your denominator, and so so that's how that date kind of comes in. But otherwise, no. When you're applying the FTE reduction safe harbor, you got to go back to February 15th. That's the key date. So you got to look at February 15th, take a snapshot of that. Make sure you had a reduction between February 15th and April 26th. If you did, then you got to take a snapshot of the day your FTEs as of the day you apply for loan forgiveness, or December 31st, the earlier of those two dates. And that number has the same as February 15th.
And just to reiterate, I mean, it's really confusing. I mean, the number of measurement points that we have in regards to FTE counts and everything else has continued. It's just a lot. So it's hard to remember them all off the top of your head. But when you're going through your application for forgiveness, you just have to go back and reread. Go back to our slide decks that we've had in the past that went over the original safe harbor concepts of what your measurement dates are and why you need to measure them, and just to remember that some of them have changed. And maybe now it used to be June 30th, and now that moved to 12/31, and then now it just moved again if maybe the earlier of 12/31 of your loan application date for forgiveness. And maybe, and we're welcome to feedback. We still have about 70 people here. If you feel like it would be a really good opportunity for us to go over some of the, application concepts again on forgiveness and what the measurement dates are and what some of the basics are, so people can, as they start going into forgiveness mode, they can remind themselves of all of their calculations that they need to be aware of. That would be fine. Okay. Hey, Bill, I think we're at this point, we're going to call it a day. Just really want to thank everyone again for hanging on with us and for being a part of it. If you have any questions whatsoever, please don't hesitate to reach out to us. I'll put our contact information up there again for you to consider. And at this point, we'll continue to keep an eye on the guidance, and we'll continue to provide more information on our website and emails as they become available. And thanks again for everyone for joining us. All right. Have a good day.
Thank you.